Hello, thank you guys for joining us today, and welcome to the Argus Self-Storage Advisors Investment Q&A webinar. We're going to move this webinar along at a very quick pace to make sure we're mindful of the audience's time and to make sure the energy level of the webinar is appropriate. At any time during this webinar, please feel free to type your questions into the question bar below, which is the icon that looks like a bubble on the bottom left-hand side of your screen. However, I do want everybody to know that over the last several weeks, we've received several sets of questions, and we're going to try to get through as many as possible. But if we don't get to your question, we will certainly follow up after the call with any questions. I'm sure many of you guys have sat in on 10 or 12 webinars over the last 8 to 10 weeks during this unusual time of quarantine to try to get a feel for where the market is today and how it's affecting the self-storage investment market. The fact is that the market today is very fluid, and over the last 8 to 10 weeks, we've actually held off on holding this webinar until we had some real data that we felt comfortable with sharing with everyone, and some real transactional data points as the market certainly has changed on us. And hopefully today we'll be able to share some information that will help everybody understand where the market is today. All of the panelists on this call today have transacted over the last 8 to 10 weeks, and the goal today is to share some real-time market info with all of you so you guys have the best take on what's going on today. I'd like to now take a minute and introduce our panelists. We're very fortunate today to have some of the most active and well-respected industry professionals on the call today, and most of them don't need an introduction, but to make sure we're all acquainted, I'm going to introduce Wayne Johnson. Wayne is the President and Chief Investment Officer of SmartStop Self-Storage. Wayne is a 20-year veteran of the industry and has completed more than $2 billion of acquisitions and dispositions throughout his career. We have Liz Schlesinger on the phone, who is the founder and CEO of Merritt Hill Capital. Liz is the former head of the W.P. Carey Self-Storage Investment Group, has evaluated more than 3,500 self-storage investments in her career and has completed more than $2 billion worth of self-storage transactions. Scott Levy is here with us today. Scott is the Vice President of Investments for CubeSmart and has held that role since November of 2011. Scott has been involved in more than $4 billion of transaction velocity throughout his career. And last but not least is the founding member of CCM Commercial Mortgage, Neil Gustis. Neil is a 20-year veteran of the self-storage industry, has completed more than $1 billion of debt and equity placement throughout his career, and his reputation as an industry mainstay is unparalleled. For those of you that don't know me, my name is Ben Vestal, and I'm the president of Argus Self-Storage Advisors. We're an industry-leading self-storage investment firm that has exclusively focused in self-storage investment for the last 25 years. Largely because of the market disruption of the coronavirus over the last 8 to 10 weeks, I'm going to start by having the owner-operators that are on the webinar today share some portfolio statistics and also some best practices that they're taking in. Why don't we start with Wayne? Wayne, can you talk a little bit about your portfolio performance and some best practices SmartStop's implementing today?
Sure. Glad to get us started. And Ben, thank you for having us on the call, and look forward to getting into it. As far as SmartStop, we have currently 142 properties with 8 new properties under development. Roughly 10.7 million square feet, net rentable square feet. That's a split between about 9.6 million in the States and 1.1 million up in Canada. We've been very active in Canada. Overall, our current occupancy is 89%. And assets under management, we have about 1.6 billion. And Ben, I understand about half of the group is self-managed, and half the group is either managed by third-party REITs or regional management firms. So that's kind of the split. We are self-managed. We operate our own facilities under the SmartStop brand. As far as some performance stats, April move-ins were down 20 to 25% year over year, but we've seen a real recovery starting really the last week of April and on into May. Move-outs down 10 to 15% year over year, and May down about 5 to 10%. So we're paying a lot of attention to those tenants that are still occupying units that may end up moving out, but so far it's tailing off. March occupancy was up 50 basis points from March, but then down 20 basis points. So to us, it seems like March, began well, strong, and then just started to tail off, and it really showed up performance-wise in April. The biggest slowdown we saw really was isolated to March 20th to about April 20th. And then we've seen, like I said earlier, a bit of a bounce. Our delinquency has not really been affected. We've collected 96% of our April rent. We consider that solid. And about 50% of our customers are on auto pay, which is about 3 or 4% higher than where we were before. But auto pay has really been a big plus for us. As far as rate increases, we have held off any rate increases, in April, May, and in June, and we're evaluating that, but we're paying a lot of attention to that. And of course, auctions, similar situation, although that is something we might, on a case-by-case kind of resume, just to clean out units that, these are definitely people that have no interest in staying there, so they need to be cleared out. One thing we did in late March, we gave an appreciation bonus to all of our on-site personnel. Call it combat pay, call it whatever you want. It was just an appreciation bonus, and that really went over very well with our team. 53% of our customers are on auto pay, and we can access about 100% of our tenants through text messaging. So that's kind of an overview of SmartStop.
Yeah, that's a great overview. Thanks so much for sharing that, Wayne. It sounds like been pretty resilient so far. Liz, can you talk a little bit? I know you use third-party management. Can you talk a little bit about your portfolio and kind of some data points that you've seen come across over the last couple of months?
Sure. As Wayne mentioned, and Ben as well, we are using both CubeSmart and Extra Space and Life Storage to manage our assets. So we are not self-managed. Basically, similar to Wayne, we saw, actually, we started the year off pretty well relative to both our street rents, our initial projections, and then also our occupancy was really strong coming into this period in March. The beginning of March, actually, and I think this has been pretty widely spoken about, we had probably one of our best early Marches that we've ever had due to the students, the impact of the students. And both Extra and Cube took the position that they weren't going to discount those as much as they have in the past. So I see that as one of the most positive things to come out of this, because we have those students for a longer period of time than we otherwise would have them. So pulling that revenue forward, but it's also going to be going forward. And we benefited a lot from that because, like Wayne said, sort of middle to March and then through middle of April, we had a very, very, very slow rentals. So in April, our rentals were actually down further than what Wayne was mentioning. Our rentals were down 33.4% in April versus the year prior. Our vacates, though, also were down further than I think what Wayne said, which was they were down about 20.9%. In May, however, we've started to see some positive changes to that. So our rentals are down a little less, 29.3%. But our vacates are down even further at 27.6%. One of the things that we've been really happy about is that we think that the renters that are coming right now are likely to be really solid renters who really need the product, particularly the ones we just signed up during this social distancing period, because you wouldn't probably be out renting a storage unit if you weren't. So we've been actively trying to, get those renters, and Cube and Extra obviously are the ones doing that because we think they're really high quality renters. Our ARs have ticked up primarily, like Wayne mentioned, because of our lack of ability to do auctions. And then also we're constantly buying properties. We have 122 properties currently. So when we buy properties, we tend to aggregate them into our portfolio, and those tend to come with a lot of ARs that we're writing off. So it's not completely clean, but we have about 3% delinquency relative. So we're collecting about 97% rent, which is something, as everyone who's listened to the earnings reports notices, that the publics are reporting anywhere between 94 and 98%. So we're right within that range of 97%. And I would say overall our occupancy fortunately has ticked up as a result of the rental and vacate trends month over month, each month. So and also has continued to grow in May, very small amount, but we did have occupancy grow 3% from March to April, so 83.5 to 86.5, which is actually very strong for that period of time, I think, given it's sort of obviously busy rental season, and we've ticked up a little tiny bit higher than that in May. But that's basically where we're at. Similar, it seems very similar to Wayne.
Yeah, thanks, Liz. Scott, you want to comment a little bit? I know you guys just had your earnings call at CubeSmart, and we won't ask for any forward-looking statements because we know you've pulled guidance, but give us a little background on how CubeSmart's seeing this and how your guys' portfolio is performing, Scott.
Sure. Thanks, Ben, for having all of us. We have 1,200 plus properties in our portfolio, owned and managed. Some of those are the properties that Liz was just mentioning. We took the strong position that we were an essential business and kept our doors open on all of our stores except for one in the Chicagoland area for a small period of time with a Barney Fife-esque overzealous code inspector that was trying to get us closed. But in general, stayed open, and we're actually very proud of the fact that we had not had to furlough any employees or lay off any employees in the whole time. So it was really an important goal for us. Through March 31st, we kept the same store occupancy at 91.5%. But I mean that's the activity definitely started to slow down in April. It sounds like our statistics are not too dissimilar from what Wayne saw. In the latter half of the month, we were down, maybe 20% in rentals versus prior year. But in the first half of the month, maybe through the 15th to the 20th, it was an eye-popping 35%, which is pretty significant from a 35% down that is over prior year, which is pretty significant when you're looking at rentals. The good news, and Liz touched on this as well, is that move-outs were down as well. And I think I've said this before, so I apologize if I repeated any of these folks on the call, but I think a little bit of that is still fool's gold, the fact that move-outs are down, because part of that reason that they're down is because we're just not processing auctions, and there's going to be some backlog that's going to get built up. And some of those are customers that just don't need to move out, so they're waiting for the stay-at-home orders to be lifted. And in some cases, it's folks that just don't want to go out and feel they can wait one more month. I think that once the auctions turn back on, and I think that's going to go very slowly as you go look state by state, and in some cases municipality by municipality, we will start to clear all that stuff out, but it's going to take some time. Our customer base is quite sticky, which is good. I think 60%. Let me try to get my numbers straight. 60% of our customers have been with us for over 2 years, and 60% of our customers with us over 1 year, and 42% over 2 years. So when you think about our ability to pass along rate increases when we turn them back on, and I'll touch on that in a moment, we feel that we're going to have some traction there to go forward and start growing revenue long term in the portfolio. Operationally, over the past 6 to 8 weeks, and I say we, and I didn't do a whole lot of work on this, but our team did a ton of work to finalize a fully contactless rental system, and thus far we're seeing north of 10% of our customers move in this fully contactless system. We've rolled it out throughout the country, and it seems like we're getting good traction there. We've implemented a lot of social distancing guidelines within our stores. So one teammate can only be in the office at a time, one customer at a time, trying to maintain 6 feet wherever possible. Masks, gloves. We spent considerable money on a per property basis for the appropriate PPE and making sure we have additional hand sanitizer. We were able to track down a distillery in the greater Philadelphia area that stopped producing whiskey and started producing hand sanitizer, and we bought 1,200 gallons of that to get to all of our stores and distributed all that out. So we're trying to be innovative where we can, and obviously keeping our teammates safe. Liz touched on the receivable side, and certainly we're seeing receivables up as well. Again, if you're not processing auctions and you're going to continue to accrue rent, the math says it is going to keep going up in the wrong direction. And we've seen an increase of about 1 to 1.5% in delinquent units, peaking in early April It has started to moderate out a little bit, but we're keeping a close eye on that, and we're looking at it in some cases weekly, if not daily. Again, just like we're looking at rental activity. I mentioned ARs. We are focusing on ARs, but we're not collecting on ARs. So it's a fine line of how you dance on that. Our managers are doing a great job calling as more of a reminder call versus a collection call, and maybe not as strong of a message to try and get folks to pay. And I think that we'll continue to do that. But again, it's a fine line, just like tenant rate increases, where you don't want to do anything that really just upsets the apple cart too quickly with your customers, recognizing that you still want to do all that you can to try and protect your shareholders or your investors, depending on who you're working for. So that's a delicate balance that I think we're going to continue to pursue, and we're watching as states continue to open up more, when we're going to turn auctions back on. And you think about that process, in some cases it's 60 to 90 days from the day that you turn that process back on until you can clear that queue back out. And on rental increases, again, the day that you turn that back on is usually 30 to 45 days before you may start to see that rental payment at all. So we're eager to do that when it makes sense, but I don't think that there's a medal for being first on any of this stuff, and we're happy to let some of the other folks that may be a bit more zealous take on some of the potential short-term customer friction to see how it works. In general, for us, we have not been immune. I think none of us on this call have been immune, but we're certainly fortunate to work in the industry that we work in, where when you compare us to many other food groups out there, we've risen towards the top. Perhaps it's tallest midget, but we're still tall, so we'll take it. And I think that for us, this type of atmosphere creates innovation, and I think that there's things that are going to come out of this. Specifically contactless rentals and other ways that we're communicating with our customers. Wayne touched on texting with customers and utilizing that more. We've been using that more, but ramping that up faster than maybe we previously would have. I think those are things that are going to start to continue to make the industry change just a bit and move forward.
Thanks, Scott. Great overview. I think the general consensus I'm hearing from all of the owner operators on the call is that there are some market headwinds, no doubt. But overall, I think we're performing a lot better than a lot of the other commercial asset classes out there. And I think it's important for us to realize that the existing customer today, your best customer is your existing customer. And so, the holding off on auctions and rate increases is I think, a prudent thing at this time. However, I do think you need to keep an eye on those ARs and also what I call phantom occupancy. If you're not processing liens and lien sales, you can, artificially have a higher occupancy than you actually are. But we're going to shift gears now a bit and talk a little bit about the capital markets. Neil, I want you to comment a little bit on the capital markets and give everyone a sense of how the debt markets have been behaving over the last 6 to 8 weeks. I know it's a very fluid market, but also comment a little bit on the sources of capital and in terms that you've recently been able to achieve for your clients. Neil, can you talk a little bit about that?
Yeah, sure. Thanks, Ben. So look, the capital markets are working through the same times as all of us, right? Unlike the first crash back in 2008, 2009, where there was a total shutdown of capital, the capital is still available today, which is good, right? Although it is somewhat limited. Lenders, like everyone on the call, are mainly focused on managing their priorities, deploying bank resources and their personnel. So we're seeing a varied response, and I'll get into that. I suspect, as you said, it'll remain fluid and somewhat disjointed for the next several months. I will tell you that there's still lenders lending and quoting. So just as a reference, Steve and I closed a 5-property refinance just last week, which was a cash out, low 4% rates. We also closed a 2-property acquisition just yesterday. And in terms of looking at new deals, I put out a smaller deal, about $2.1 million loan request, and got varied responses. I had several lenders that said, they weren't in the market or weren't interested or on the sidelines. And I did get a couple quotes and one very aggressive quote. So that being said, the markets are still open. The deals I just spoke about, they closed, they took 30, 45 days longer than typical. And I think that's what our mindset should be going forward, that it's just going to take longer to get deals done. To piggyback what Scott was saying about the tallest midget, and I'm not sure if that's politically correct anymore, but I do want to comment on the property types that lenders are looking at today. And once again, self-storage is one of the few property types that are favorably looked upon right now. So when I talk to the lenders, the common threads are self-storage, multifamily, industrial, particularly distribution, and grocery anchored retail. Everything else is kind of on the sidelines at some level, or a little more tougher to do. And typically in addition to the typical underwriting that the lenders are doing, they're looking very closely at activities since, say March 1st or March 15th, in terms of your occupancies, your delinquencies, your lease ups, your move in and move out rate. And they're really, like all of us, trying to get a handle on what the performance is going to be looking like going forward. That activity is going to be all over the board. Particularly, we look at location, but the added dynamic of the COVID-19 is that all the markets are opening up at a different level, and so there's going to be different activity levels all across the country in every market. So generally what we're seeing is we're still seeing low rates, slightly higher than pre-COVID rates. If I was to generalize, I would say rates are 50 to 75 basis points higher than pre-COVID rates. I suspect the indices are going to remain low for the future, for foreseeable future. But again, we're a little exposed to how lenders are looking at the risk and pricing the risk into the spread. So we're seeing the spreads, moving out a little bit. In terms of the loan quotes that we're seeing, they're more conservative. LTVs are 50 to 70% LTVs, and also starting to see some structure built in. So we just apped a deal a couple weeks ago, where they had a 6-month P&I reserve built into an acquisition deal. I'm also a little concerned about the approach of valuation methodologies going forward. I think we'll talk about cap rates more, but I do think that it's more important than ever to, when you're closing these deals or financing these deals, to use one of the national appraisal firms, because they're going to have a more consistent approach to self-storage. Let me just talk about the sources, as you said, asked about, Ben. So, banks and credit unions, they finance 85% plus of our industry. Right now, the last 8 weeks, most of them have been focused on getting the PPP money out and processing that and getting those funded, as well as dealing with deferrals and forbearance and everything else in their portfolios. So it's been tough to get their attention. I think as the PPP processing is kind of coming to the ending portion of it, we'll see them redeploy their focus, and some more of the lenders, I think, will start looking at new deals. Self-storage developers usually go to the banks to get financing. I would tell you that I think Development deals aren't going to be impossible to get financed, but they're going to be very difficult. And certainly all the assumptions that were made 3 months ago need to be relooked at, both from the owner's standpoint and the lender's standpoint. From the banks, they're all obviously also offer SBA financing, and right now financing from SBA is going to start looking more favorable for smaller and mid-sized deals. You know, the financing can go up to 85%. Because the indices are so low, the SBA overall rates are mid-4s to mid-5s, so that's not so bad. They may be a very good option going forward. Some are only lending on income-producing properties, such as Live Oak is putting all construction SBA financing on hold. In terms of that CMBS, we saw CMBS lenders go to the sideline mid-March, and the good news is we've seen a couple of the lenders, at least a couple of lenders, start quoting deals again. A little more conservative, not bad, but the rates are 1% or more higher than they were pre-COVID days. Life companies, they are more selective than ever, low leverage. One interesting thing I found out about the life company deals is that they're actually giving you credit via interest rate reduction for building in structure into the deal. For example, building in P&I reserves or even going recourse. So that's interesting. And then lastly, I'll touch upon bridge loans, which are mostly utilized by people in lease up right now. Many of the bridge lenders are on the sideline, and certainly the rates vary depending on the lender, from 5% all the way to 10 to 12%. The common thread on bridge deals is that they all underwrite based on exit valuations. So they're not necessarily the magic answer for a property that's in an area that's overbuilt or is seeing low lease up, or rental rates that have gone considerably south from their pro formas. But all that being said, there are fewer active lenders today, but we are finding plenty of lenders open for business. And I think as we move down, if we were to have this call another 30 to 60 days from now, there would be even more lenders that would be active in the self-storage space.
Thanks, Neil. That's a great overview. And I'm hopeful everybody on the call finds this information helpful and real-time information. And certainly with regards to the best practices, I think that's a good thing to share with all the owner-operators. But I think we're all here to talk about the investment market, and I think everybody understands that we're operating in different times and we need to readjust our barometer here. So let's start to dig into some of the investment market questions we received over the last couple of years, or over the last couple of weeks. The first question is going to be directed at Liz. Liz, with the disruption of the COVID over the last few months, how are you pricing stabilized deals, and are you underwriting trailing operating revenues, or are you still building in year one growth, or how have you tempered your underwriting parameters? Can you comment a little bit about how you're evaluating acquisitions today?
Sure. A lot of it relates to what Neil was saying. I think initially everyone thought with rates going down, people were excited to start looking at debt, but what unfortunately happened was not just structured pieces of the puzzle, but also just debt proceeds are materially down. So rates are up and debt proceeds are down, and therefore for where we sit, to get the same returns that we usually try to achieve, it's a lot harder to price things the same way as we did pre sort of COVID and these changes in debt. I would say that we've never been very aggressive on first year revenue growth, and that's primarily because, quite honestly, we almost always have negative revenue growth the first year of any deal we buy, because the transition from one platform to the other is actually a lot more complicated than I think a lot of people realize. And there's a lot of cleanup of delinquencies and all of those things that often are not cleaned up. So we're cleaning it up and then getting ready to hopefully grow revenue after that. So we are underwriting, like always, relatively slow revenue growth the first year, even slower as a result of the fact that I think one thing I don't think anyone's mentioned yet is that, like, we're doing okay now, but I don't really believe the results are showing the impact of what's going on. And I don't think they're going to show it until probably a few months from now, because storage is a relatively slow moving business, and it's a positive thing. But for now, for our results, they're obviously very strong. But I think over time, the impact of these lower rentals and the fact, like Scott said, that vacates are down, but they're probably going to increase, hasn't really shown up in any of our numbers. So we're sitting pretty now, but I do think towards the end of the year, we're going to have some erosion in those results, which is what we're trying to somehow take into account with our acquisitions, while also of the mindset that we still love the asset class and we still think we are relatively better off than other asset classes. So we're trying really hard to make deals work. We've closed 7 already that we had signed up prior to COVID in the last 2 months, including one when I had Corona myself, so that was fun. But we've definitely been honoring all of the deals that we had at the terms that we had them signed up at. But our terms now are longer DD. It's 60-30 versus before we do 35-15 deals. We also have force majeure language just in case municipalities are really difficult to work with, which we have had some slowdowns in municipalities. And we're also underwriting a lot more conservative debt proceeds and revenue growth, because we think that's pretty much a given for this year. I would say that means that, bottom line, our cap rates have probably adjusted about 30 to 50 bips. And it's really in large part related to debt more than any long-term concerns about storage fundamentals, because debt, yield is way, way more important. So you just can't make a 4 cap work like you could before, because lenders need actual cash flow to lend on.
Thanks, Liz. That's a great overview of what you're adjusting with regards to underwriting since the COVID disruption. We're now going to move on to the next question, and I'm going to direct this at Wayne, and then Scott can do a little bit of a follow-up. But how does the group feel about valuations of new development deals and properties in lease-up? We all know that there's been a big surge of development over the last 3 to 5 years, and there's a lot of properties that are in lease-up. Is there a market today for lease-up deals, and how are you guys viewing lease-up valuations? Wayne, can you comment a little bit on that? I know you bought some of those and are active in that.
Yeah, sure. We continue to, evaluate and make offers on lease-up deals. C of O, the true C of O type transactions, there's still some that keep coming in and are out there. Those are harder to evaluate, especially right now. So, the lease-up deals, we really use the same parameters as what Liz touched on. Now we're in an early lease-up mode. What level of discounting is going to be needed? What would be the baseline revenue that we could have as street rates? There's a reset there, most likely. How long will those discounts continue on? So we're stretching out our assumptions on, how soon we'll stabilize. We used to look at a year 3, maybe 3.5 years into a lease up as a stabilized NOI, and maybe we tack on more time to that. The real challenge, 2 challenges, one, but are one, where do we price, rates, and will those rates hold? And, our economy, it's still in flux, and are things going to continue to get better, or are they going to drift to more negative as the year goes on? And the other challenge on lease-up deals, and especially C of O deals, would be just obtaining the debt. It's tougher to find financing on a stabilized, or I mean on a lease up deal than a stabilized deals. We can still get them. We've always been a low leverage borrower, which helps. But there's Neil could probably confirm this. There's probably fewer lenders on lease up deals, and they're tougher on their quotes and rates. So those deals from our standpoint need to be compelling, fairly priced. It's not business as usual. As far as from the seller's side, I think the sellers need to be somewhat realistic about, how we will look at revenue growth and rate growth and, just performance.
Thanks, Wayne. Scott, can you add anything to that, or how is CubeSmart? I know you guys have a program to buy lease up deals and have bought a few C of O deals. How are you guys viewing that market today in light of the disruption today?
Yeah, we haven't closed on a CO deal in over a year. But we have focused, Ben, to your point on lease up deals, and I think that Wayne really hit the nail on the head when you're looking at lease up deals. When you're looking at any deals in this environment right now, whether it's stable or lease up, where we're trying to get to is where do we think stabilized rental rates will be? And I think on a stable deal, it's easier to know because you have most of the occupancy, but on a lease up deal, we would have a relatively good idea. We would think at least of how long it would take that property to lease up. And then it would just be a question of trying to solve for what that appropriate rental rate is. I think in the environment that we're in right now and not having a good understanding of what consumer demand is going to look like in the near term or as we come out of this, as the economy opens back up. Now, instead of having one variable just being what rental rate is, you probably have a second variable where occupancy may take longer than originally noted. And Wayne touched on, and I agree 100% that we're elongating out what our lease up assumptions would be to factor that in. And you just have some noise right now in pricing with operators just fluctuating pricing up or down, utilizing discounts in ways they had in the past and utilizing marketing dollars in ways they have in the past. So it's becoming even more difficult to try and decipher what that stabilized rental rate is. And I think all of that adds complexity when you're trying to figure out what a lease up deal is. So it remains challenging. I think that to an extent, a friend of mine said this to me, that on some lease up deals, it's going to be like dating. You're just going to see a deal and you like it and you really can't explain why you like it. You're going to go after it a little bit harder. And there's going to be other deals that someone's going to go after hard. You're going to say, I just don't get why they did that at all. But I think that I don't think we're going to be fully in a full distressed market, at least at this point. But I don't think that the pricing that folks expected from 60 or 90 days ago is going to hold up, at least in the short term, until A, we get a better understanding of what the economy looks like, and B, to Neil's point earlier, you see debt capital move back towards where it was before.
Yeah, I think, coming from my perspective on the investment sales side, the disconnect in selling a lease up deal is where the rates are going to stabilize. The seller always believes they're going to stabilize much higher than the buyer. So that also speaks to Neil's point about the debt side, right? I think when you're out, have a deal that's in lease up or whatever, it's important that you monitor your rates, because sometimes the heavy discount that are priced in for the algorithm-based pricing models today really affects the way the lenders look at it, because they look at the in-place rental rates and not necessarily where they're going to stabilize out. Can I ask you guys, or anybody on the panel, to comment a little bit? How much do you focus on price per square foot when you're looking at a square footage or a lease up deal? Liz, do you have any comments on that? I saw you perk up when I said that there.
It's everything. Particularly as it relates to lease up deals, although we stay pretty far away from them usually, but it's a ratio to me in terms of the underlying rent relative to what you're paying for it on price per square foot basis. And so for us, when we look at lease up deals, it's always a cursory look, and again, we haven't done that many over the years, and we definitely aren't doing many now. But if someone wants $200 a foot for a lease up deal or any deal, then that requires $20, $30 rents per square foot. And while everyone has that in their projections, we all know Excel can tell you whatever it wants. And the reality is there are very, very, very few markets that are really solidly $20 a foot markets. And so for us, it's a very good barometer, particularly to look at lease up deals in terms of like the believability of whether or not we think they will actually work in the long run, since of course it all does come down to rents, and it all does come down to what you're paying for whatever you're buying. So I also personally think post-COVID, how much you've paid for these is going to also define how much you have to rent them for. So if you're the highest priced option in a market, like, and you're selling like, really pretty storage, I think, first of all, I never believed in that. I don't think you make money on pretty, but I think also, like now that strategy is even more challenged because people are going to be looking for value options more and more, I would think.
Yeah, Wayne, do you have any thoughts on price per square foot?
Yeah, I mean, that's one of the measures that we'll apply. I mean, we're focused initially on realistic revenue projections, realistic expenses, and leading to an NOI, and then you kind of back up with, okay, what does that mean on a price per pound and price per square foot? How easy would it be to duplicate that site nearby us or somebody else? Sometimes the comps get out there and there's a comp of 200 a foot or whatever it is that might attract other developers into that market if they can get something done. So it doesn't help in the case where it's too high per square foot, but in the past we've stepped up and in some cases feeling like the barriers are high enough that it's worth some risk.
Thanks, Scott. Anything to add?
Yeah, I would say with respect to per foot, it's something that we look at similar to what Wayne said. It's not the only decision point for us. I mean, we are at the end of the day yield-based buyers, so that's what our main focus is. But I mean, to look at something where you're so far past what replacement cost would be, and you think barriers to entry are low enough where you could just do it yourself. We certainly have had those conversations.
Thanks. We're going to move this on to the next question here, and this one is going to be directed at Scott because since he's the only public REIT representative on the call today. But Scott, for those of us that listen to the earnings calls, it's clear that the balance sheets of the public REITs are much, much stronger today than they were in the 2008 and 2009 crisis, financial crisis. So they're in a much better position for acquisitions coming out of this. Do you feel the public REITs have also been very, very disciplined over the last couple of years with regards to acquisitions? You feel coming out of the post-COVID situation, do you think the REITs are going to be more aggressive with acquisitions than they have been over the last couple of years?
Yeah, I think you hit the nail on the head that for sure all of the REITs are far better capitalized than they were previously, in a much better financial position with more than ample liquidity to go out and certainly bulk up. I think when you think about stable deals, again, when you think about what I talked about as far as the risk reward, as far as trying to figure out stabilized occupancy and stabilized rate versus just stabilized occupancy, I think that the market and demand for stabilized deals is not materially changed, and I don't expect it materially to change from a demand perspective of the REITs. I think that you're going to have some deals that are lease-up deals where it took a year longer or 9 months longer to build it, and your rates are 20 to 40% below pro forma, and either your equity or your debt or the developer's equity or the developer's debt or both want their money back, and that developer is going to be forced to sell at a time but before they were ready to do so, and probably at a price point lower than what they had originally anticipated. I think that some folks might call that distress. I think that the other side of that is, like I said, you got a ton of folks that are well capitalized to be able to buy it, so it isn't like you're just going to have one or two buyers, and by definition, the more buyers you have, and when you have more demand, that's going to keep your pricing up. So I don't think you're going to see true distressed pricing. But again, you're not going to see the same pricing levels, at least in the short term, I think, that we saw, a while ago, until some of the markets stabilize a bit more. And I think all of the REITs, and I don't want to speak for all of us, but we have the advantage of being able to be patient, and we can wait for those deals to come in, and I think we all plan on doing that. But that said, I think when all of the REITs see deals that tickle their proverbial fancy, that we're all going to be pretty aggressive when we're able to do that at returns that make sense for all of us.
Yeah, that's you made a good point. I think the market is so much more well capitalized today than it was 10 years ago that I think that's going to change this cycle a little bit. And the other thing is, if I had if you guys knew how many times I got calls over the last 2 months asking, for distressed asset opportunities, we've seen very, very little distressed asset opportunities. I think there will be some later this year, but I think they're going to be few and far between. And I think self-storage is a very well-capitalized asset class. I do think there is going to be some lease-up opportunity, but it's not here yet. Moving on, I'm now going to ask Neil to answer a question that came in earlier this week about the debt markets. Neil, before COVID disruption, we had arguably the most aggressive and fluid debt market we've had in history. sub 4 interest rates, interest only, lots of really aggressive debt quotes being thrown around. Do you feel pricing for self-storage debt is going to be better or worse as we come out of this in the second half of 2020?
So it goes back to the fluid market, right? It's hard to say what the perceived risk spread is going to be. So I think relative to all the other commercial real estate types, Ben, we will be priced among the most aggressive of anything that's being priced out today. So I think what helps us is I think the indices are going to stay low for a long time. So it's just going to be the spreads. And so I really think we're not going to see tremendously higher interest rates than we are today. I think it's going to be more based on the conservative terms and how the underwriting's done. And again, it's what the conversation has been for the last 10, 15 minutes. What are rental rates? And I think the most important part of that equation is self-storage lags, as Scott mentioned. So, even though there might be real discounting going on in the market, in a given market, for a stabilized property, 70, 80% of those renters aren't moving out, and they're still paying the rent that they were paying, 3-4 months ago. And that's more relevant to me than the rates. I don't see the rates moving dramatically in the second part of the year.
Thanks, Neil. We're bumping up against our timeline here. I've got 2 questions that I'm going to ask the group before we wrap this up. This question is going to be directed at Wayne and Liz mainly because they are actively in these markets. But question is, I've been told that secondary and rural markets have seen less disruption during COVID. Do you feel that the small market deals are less volatile than the major market deals today? And if so, how much of a higher cap rate do you put on smaller market deals because of their location and market geography? Why don't we start out with Wayne? Can you comment a little bit on how much of a spread between the core markets to secondary markets there is today in cap rates?
That's hard to say. I mean, we haven't been really active in the secondary and rural markets. I mean, my attitude towards those would be you really have to kind of buy them right because historically rates have not moved. Rental rates, expenses, et cetera, haven't really moved tremendously in those markets. They're solid. You have to buy them right. It's almost like buying an annuity that you can tick up. So we've purchased a number of facilities that's how they turned out to be performing for us. So I'm not sure if there's a 50 basis point premium to a more suburban or closer into a higher MSA compared to that, but there's something to be said for the steadiness of those deals, and if there's lack of new construction supply that comes in, you can do fine.
Yeah. Liz, do you have anything that you want to add to that with regards to secondary markets and really the spreads between core deals and secondary market deals?
I think, we love them, and we were sort of early to the trend of buying secondary and tertiary markets, and I still do like them. The only thing I would say is that we initially liked them because we felt they were appropriately priced relative to the primary markets, and now that more and more people have been buying them recently, and the spread isn't as appropriately priced in my view, because the bottom line is no matter how much you like them, and I do like the secondary markets and the tertiary markets a lot, they're just not worth as much as primary markets. And that's primarily because the end user of all of the, or the end owner of a lot of this is, sort of the Wall Street REIT mafia, the shareholders of all of the public REITs that basically bottom line top tier markets that are very liquid. And in this market, you're starting to see that that the primary markets are more liquid and the secondary and tertiary markets are having a lot harder time selling and getting the same pricing. So I think for the right price, absolutely, the secondary and tertiary markets we love, but you can't sort of look to the primary market cap rates and apply those directly to the secondary and tertiary markets and think that your site is worth that, because to Wayne's point, like, people can build on it. Like, it's just not the same. There's not as much durability in the actual real estate and the asset long term.
Thanks, Liz. You know, coming from my perspective, and as you guys know, we transact a lot of deals in the secondary market, and what I would tell you is what we've found is that over the last 60 days, the secondary markets have become less liquid, and not only because there's less buyers for them, but there's less lenders that are willing to go to those secondary markets. Therefore, I think over the last, call it decade, as we've come out of the economic recession, we saw the cap rate spread between core markets and secondary markets really tighten up, as Liz was mentioning, where she used to be able to buy a 7 cap in Bentonville, Arkansas, that maybe is now a 6 or 5.5 or something like that, where I think what we're finding over this last 60 days is we're seeing the secondary market cap rates expand much faster than the core market cap rates, simply because of the liquidity that many of you guys have mentioned. So thank you guys all for that input. I do want to be mindful of everybody's time today. Our slotted time frame was 45 minutes to an hour. We're bumping right up against that. I'm going to ask the group one last question that we can all I think it's a question that's a moving target, and the folks on this call probably don't always like answering this question because I think it varies from deal to deal. But I think everybody that is on the call wants to understand where your guys' head are with regards to cap rates. And so I'd like to ask the group, will you guys just comment on whether you feel cap rates will be higher, lower, or the same after we come out of the COVID disruption? Why don't we start with Scott?
Sure. Yeah, that's an incredibly hard question. I think that you think about some of the things that Neil talked about as far as debt costs going up. Liz talked about as well as far as being able to get less proceeds. And I think all that tells you that cap rates theoretically are going to have to go up, at least at some level. That said, there's still a plethora of buyers that want to buy, and that's working on the other side of that, which I think could bring cap rates down. It's probably a bit of a non-answer, but I think that it's too early to tell realistically long-term how cap rates are going to look. I tend to believe they're going to go back towards more historical or averages that we've seen, pre-pandemic, but we still don't have a full understanding yet of what the customer's reaction is going to be and what customer traffic is going to be. And until the economy really opens back up again, I think it's going to be a bit of a beauty in the eye of the beholder from a deal by deal perspective.
That's a fair statement. Wayne, where do you think cap rates are going to shake out?
I think they're going to remain flat, or maybe go up 25 basis points. But the variable, I think, is going to be what are you underwriting and what are the rates? So those would be at a lower adjusted, net revenue when it's stabilized.
Thanks. Neil, you want to comment on cap rates?
Yeah, I think Wayne just hit it on the head. I think cap rates are going to be fairly flat, but it's going to be in the eye of the beholder. So up to COVID, you could say that the Liz and Scotts and Waynes of the world kind of priced deals on what they kind of projected out and saw what they saw in the future. It maybe implied a little of a premium because they knew that they could maybe run the property better. That same logic is going to go maybe going negative going forward, in that those projections or the eye of the beholder isn't going to look as bright. So that's on the buyer side, and on the appraisal, it's going to be what the appraiser uses in terms of revenue assumptions, regardless of what the cap rate, what their capitalization is. So I think valuation is going to be all over the board, where cap rates may stay the same. It's about eye of the beholder.
Yeah, if you think about what Wayne just said, I think he hit the nail on the head. I mean, a 5 cap on a deal 120 days ago, or sorry, a 5.5 cap, or sorry, 5 cap on a deal 120 days ago to a 5.5 cap deal in the future, but NOI has moved enough. The yield or the cap rate may not be that materially different based on how you would have previously looked at it, but the price or the actual value of the asset could change somewhat materially, and I think that's all still to be seen.
Yeah, so it's more operation of deterioration of the deterioration of the NOI is affecting the value. Liz, do you want to comment on cap rates? Where do you see cap rates going?
I think exactly what Wayne and Neil and Scott have said. I think the cap rate is so hard to define anyway. Is it adjusted by taxes, what revenue, all of these things. But I think that values are going to probably go down to Wayne's point, because I think, as I mentioned earlier, I think the worst is yet to come in our numbers for where NOI is. So, no matter if cap rates even stay the same, the value is going to go down by default. But I do think that overall we still are in a great space, and I think long term we're going to be standing strong. And I honestly love this industry and feel really happy and lucky that I'm in it. And we're ready and open to buy. So we don't have a vulture approach, but we also have a moderated approach. I think that values are going to be down, and I think, as evidence here, everyone that's buying feels the same. But we don't think it's like a doomsday either.
Thanks so much for that. And I agree. Our business model is just so much more sound than the other food groups with regard to the short-term rental nature, the low capital outlay, no tenant improvements or leasing commissions. It's very direct-to-consumer business. There's a lot of things that our business model sets us apart from the other food groups. But we've closed 12 deals in the last 60 days, and by all intents and purposes, we think cap rates have moved up 10 to 30 basis points due to the pandemic and the disruption. And I think Scott's point is that it's really too early to tell, and Liz's point about there's just not enough operating data out there to fully understand the effects of this disruption. But we are over 45 minutes. I want to thank everybody for their time. I hope everybody on the call felt this was helpful and informative. I know I did not get to everybody's questions that submitted one, but we will follow up with each and every one of you over the next week. If you do not hear from us, please reach back out. Thank you guys all for participating in this. This is the conclusion of the Argus Self-Storage Advisors Q&A webinar. A recording is available if any of you guys would like to receive it. Reach out to me personally or any one of the Argus brokers. We can provide you a copy of the recording. Thank you guys all, and have a great day.
Thanks, Ben. Stay safe.
And stay healthy and well.
Bye, guys.
You too.